As you all have heard from the news, the feds are increasing interest rates, and you can potentially see your interest rate at or above 5%. Hey, I'm Rose Gonzalez with the Gonzalez Real Estate Team, and my goal is to give you as much information on the home buying process so that when you're ready to make that move, you know what to expect and that you're prepared so that the home buying process can be a great experience for you and your family. In this video, we're going to talk about your options with rates increasing this year, whether you're buying a resale home or waiting for a home to be built. Let's first talk about the conversations you should be having with your lender now. I recommend talking to your lender and asking them, based on today's interest rates, what your payments look like now. How much has it gone up, and whether you're still able to afford it. It would also be good to run a few different scenarios, like if rates went up to 5.5% or 6%, what is a maximum purchase price you can qualify at and what the payments will be. It's good to know what interest rates you would be capped at for your home purchase. Let's start with resale. The good thing about resale is you can close as quickly as 30 days. So once you get an offer accepted, you can actually go talk to your lender and lock your rate right away. The sooner you can get into contract, the better it is for you before prices and rates continue to go up. If you're in contract, you'd want to talk to your realtor about your contingencies. In this market, I would highly recommend holding off on removing loan contingencies when making an offer because rates are changing so quickly right now. If you remove your loan contingencies and rates go up more than what you can afford, you can be at risk of losing your earnest money deposit if you get out of contract. There are two things in the contract that you'll need to look at. On page 1 of the contract is a section that states interest rate not to exceed, and your realtor will specify that rate. And then on page 2 of the contract is where you'll find a loan contingency. The standard California contract will specify 17 days, but some realtors will decrease that amount of days to be a little bit more competitive. They'll usually confirm this with your lender. If this loan contingency is removed, like I said earlier, this will impact your ability to get out of contract without risking your earnest money deposit. So make sure you're aware of what your contract says about these two things. Now, if you're buying a new build, this is a little bit more complicated because you can't lock your interest rate until you're closer to your closing date. Typically, if you go into a contract on a new build today, you're looking at 6 to 10 months and sometimes even longer. The other thing you need to know is that some builders are still getting delayed even longer. If you know that you're getting closer to your closing date, you need to connect with your lender about rate lock options. Lenders usually do a 30-day rate lock, but you can talk to them about doing a 60, 90, or even longer, but know that longer rate locks will cost you money. What you will want to talk to your lender about is whether paying a longer rate lock will save you more money in the long run than paying a higher interest rate on a 30-year loan. You'll also want to look at your sales contract with the builder and see if there are any loan contingencies. If you can no longer afford the home, are you able to get out of the contract without losing your deposit? Now, if you're out in the market looking for a new build, these are some things that you'll want to ask the builder or have your realtor who's representing you ask. Some of the builders will take an extra deposit for the upgrades you make to the home when you go to the design center. So make sure you keep that in mind and determine the amount you have to put down and the risks if you get into a position where 6 months down the road that you need to pull out of the contract because interest rates may have gone up. What you don't want to do is get stuck in a contract or lose your earnest deposit and your design center deposit. There are a lot of different options when it comes to interest rates. Like I mentioned earlier, you can pay for an extended rate lock. You can buy down your interest rates, but sometimes this can all get very costly. Make sure to talk to your lender to weigh out those options. Another thing that I've been hearing lately is adjustable rate mortgages. But before you consider this, please understand what this fully means. An adjustable rate mortgage is a mortgage loan that's only fixed for a smaller duration. They range from a 5-year fix, a 7-year fix, or a 10-year fix. So basically what this means is that the rate they give you will stay at that rate for whatever length you choose. For example, let's use a 5/1 ARM. The adjustable rates have a lower introductory interest rate. Let's say, for example, it's a 5-year ARM with a 3% interest rate. After that 5 years, the rate will change based on what the current rate index is. I would talk to your lender about how much the rate can go up in 5 years and really think about whether this is a safe enough option for you. Make sure you ask a lot of questions and really understand what you're getting into before you move forward. I hope you found this information helpful. If you have any questions, please feel free to comment below or send me a message and I'd be happy to help. And also, don't forget, if you haven't subscribed to our channel, make sure to give a little love to that subscribe button, and we'll catch you on the next video. Bye!